All right, thanks, Kim, and good afternoon, everyone. Thank you for joining us today for this special webinar to discuss current market volatility and the performance of our standard pools. My name is Greg Burris. I'm Director of Investment Portfolio Oversight and Reporting here at the Foundation. And on behalf of our executive leadership team, we certainly welcome you to the call today. If at any time during the webinar you have questions or would like further clarification on a specific topic, we encourage you to post your questions in the chat window. Tim and Travis will address these after the presentation during the Q&A portion of the webinar. If we do not get to your question today, we will follow up with you after the webinar. The webinar is being recorded and the link will be added to FFTC's website. That's fftc.org. Once on the main page, you can go to the menu. And then under the menu, go to Engage and select Events and Webinars. Again, thanks for joining us today. I'll now introduce Travis Pruitt and Tim Westrich. They are our lead consultants in our relationship with Mercer. Travis will be leading the discussion, certainly addressing current market conditions as well as portfolio performance through the end of April. So Travis, I'll turn it over to you.
Great. Thanks, Greg, and good afternoon, everyone. It's great to be here with you again, albeit it's been an exciting time this year, things to talk about. I'll apologize up front. I'm a little under the weather today, so if I have to pause and cough and take a drink, just bear with me. So we'll, as Greg said, we'll recap where we are through the end of April and give you a sense of where we are here, at least through last week in May. The market has changed, expectations have changed around the world, and results have come off a bit more. So we just want to give you an update and let you know what we're doing with the portfolios and how we see things. So if I start with a recap through the end of last week, you can see that returns are by and large pretty negative on a year-to-date basis and for the quarter-to-date through 5/20. Just as a signpost, I probably should have added this on here. The S&P 500, for example, year-to-date through the end of the first quarter was down about 6.5%. So you can see that, and it was by and large the S&P had held up much better than much of the equity markets in the U.S. Through that period of time. But in many ways, the S&P caught up with some of the other asset classes. You can see small cap stocks still pretty light in terms of returns for the year, down a little over 20%, and some better relative returns out of things like developed markets like EFA, developed non-US markets like EFA, and emerging markets have even held up a bit better at the index level versus the S&P 500 year to date and for the quarter to date. Perhaps, not fun, but perhaps not out of the ordinary that we do periodically get these kinds of equity pullbacks. What is different this time, or what's unique this time, is that it also came along with a big drawdown in bonds. And we have seen rates increase over most of the course of the year, up really till the last several days. Rates have gone primarily up. And as a result, that has led to our broad investment grade return of down 9. For the first 4.5 months of the year, with a pretty big drawdown since the end of March. So that's the part that is different and unique this time than perhaps we've seen in other equity market sell-offs. And in fact, in some ways, the higher interest rate environment does react and cause some downturns in equities. If we narrow our focus a little bit and look more closely at just U.S. style stocks and talk about what style overall has done, you can see the S&P 500 return here. We can see that the growth style has really underperformed over the course of the first 4.5 months of the year, and it's really those higher expectation stocks that had much greater valuations, much higher long-term expected growth rates. As interest rates rise, does make, when you run that through your valuation model as a stock investor, it makes those stocks a little bit less attractive. It brings down the long-term price that you expect out of the company. And so that brings prices down. We've also seen investors' appetites for companies that, for example, don't have current earnings, perhaps have long-term earnings growth expectations, but perhaps currently don't have earnings. We've seen investors appetites changed in the short term, and that's contributed as well to some of the sell-offs here in the Russell 1000 growth, which is the large cap index, and the Russell 2000 growth, which is the small cap index. And you can see the value comparators of those, the Russell 1000 value down still, but down less, and the same with the small cap value, down still, but down less. You can see though, excuse me, implied in these quarter to date numbers is that most of the downside has come since the end of March in those categories. And so the sell-off has broadened, albeit it is still focused primarily in those growthier assets. We are pretty neutrally exposed with some bias to value in our non-US portfolios, but overall we're pretty neutrally exposed today, with the exception of owning some lower volatility strategies. And so this USA Min Vol Index, you can see that has been additive in both our US and our non-US portfolios on a year-to-date basis of those stocks, which are more attractively valued as well as more conservatively positioned as companies have done relatively well. Again, hard to be excited about being down 13, but if your option is being down 17, down 13 is not a bad outcome. So what's led to this? So as I mentioned, 10-year bond yields pretty much across the curve have gone up over the course of the year. This chart is only through the end of April. What you'd see if we ran it through the end of May is the bond yields have rolled over a little bit. The 10-year Treasury peaked in early May, just north of 3% in long-term yield. This morning when I looked, it's about 270, a little bit higher than 270. So we have seen yields roll over a little bit in the short term here, and that's again true across the maturity curve. So everything from shorter term bonds out to these longer term bonds have rallied a bit in recent weeks. And some portion of that we think is some realignment around inflation expectations. So inflation expectations really accelerated. I'm sorry that I couldn't get May 2022 to jump up here for some reason on my chart, but through April, through the end of April, we did see inflation expectations accelerate, and this 5-year inflation break-even rate is what's priced into the market around the assumption for future inflation. And we did see inflation expectations accelerate, which led to higher interest rates, to investors seeking to get more yield to accommodate for that higher inflation. But we have seen those rates roll over here more recently in the last few weeks. So we're going through a pattern right now that the market is trying to get a handle on. Where is inflation going to go? What do future rates look like? Certainly, we know that short-term inflation has been quite significant, but as we move forward, the market appears to be looking for a new footing, if you will, on inflation. And so that's something we're watching. And it's not just the 5-year inflation sort of current rates, if you will, but if we look at the market's measure of what future expectations are. So this is the 5-year. Basically, this chart tries to read what the market is pricing in for inflation expectations for 5 years from now. And so it's a future reading, but the most important thing here is that you can see that over the last several weeks, we have seen those expectations come in as well. We don't have a view on that per se in terms of the short-term movement. It's pretty new, but it definitely impacts the way that we think about portfolios and as we think about what the rest of the year and often to the next few years could take into account. And so that is a change, and that has had some near-term impacts. One of the near-term impacts of those rising yields is mortgage rates. So as we think about what could impact economic growth, what could slow the economy or have impacts, we do think that rising mortgage rates could slow the housing market. That could in part be driving some of those reductions in inflation expectations, as housing is a meaningful portion of the inflation measure. So as I say it out loud, that sort of seems almost counterintuitive that it wouldn't make inflation worse, but one might look down the road and see moderating house prices if the cost of owning one goes up, if that makes sense, with having a higher mortgage rate, reducing the amount of what you might be able to pay for a house. We could see some reduction in those figures. But this is just one data point that's supportive of, we do expect to see some slowing of economic growth as we proceed through the year. Whether that's an actual recession or not, I think it's hard to say that for sure. But clearly we've had some slowing. We did have a negative amount of slowing in that. We had negative growth, we had negative GDP in the first quarter, primarily as a result of just not exporting as much as we have. We do expect that as inflation rates are high, gas prices are high, consumers and things like these rising mortgage rates, we do expect the consumers will perhaps be under more pressure and not able to spend as much as they had. So we do expect some slowing growth through the rest of the year. We're not expecting for any major downturn. We're not positioning for any major downturn in terms of economic growth, but we are expecting for slower growth, and that does influence some of our positioning, which I'll talk about next. So from a performance perspective, I'll spend a couple of minutes here. Through April, two of our better performers so far in April and year to date have been U.S. equity and non-U.S. equity building blocks. The U.S. equity portfolio has been outperforming for the brace of the year, and you can see that in the year-to-date number. The non-U.S. equity got off actually to a bit of a rough start, but has recovered that performance so far year-to-date. So while down, we're happy to see premiums, but you can see just in looking at these two figures, you can see that having that non-U.S. diversification is really benefiting the portfolios today. And we own, call it 55-45 U.S. to non-U.S. on average in the portfolios, and that's been additive so far this year. Global opportunities, which is, it's been a hot topic of conversation throughout our webinars and with our conversations with investment committees. It is one of our more high expectation strategies. I like to think of it as our most active strategy. Has struggled with performance about the last 15 months, but through April, we did get a nice bounce in outperformance. Some of the brace of the underlying investment manager strategies outperformed, and that helped support in the down market. So still very much like this portfolio, still maintain allocations to it, but it has been, for those investors in the diversified long-term growth strategy, it has been a contributor to some performance challenges at the top level. But like I said, we're still very committed to what we're doing here. We think these are the kinds of managers and the kinds of exposures that a long-term investor should own, but recognize that it comes along with some excess volatility. Real assets have really been a pretty good place to be. You can see for the quarter, across most of our real asset investments, we, relative to broader markets, those investments held up pretty well. Albeit in April, we did see for the first time this year for things like natural resources stocks, which is the bottom stanza here at the bottom of this chart. Those were positive in the first quarter, so we did finally see those catch up a little bit in terms of equity market sell-off in April. But in the grand scheme of things, those have been good things for us to own. As I think I mentioned in our last webinar, try to be diligent in keeping these allocations near our long-term targets rather than let them run too hard. They do contribute they have the potential to contribute excess volatility. So we've used periodically some of this excess return to fund cash flow needs or rebalancing needs. Lazard at the top of the page, our infrastructure position, small position overall in most of the portfolios, but they are fully hedged. They're a global portfolio, but they're fully hedged to the US dollar. And if you've seen what the dollar has done this year, much of their outperformance really comes from that currency positioning. So while we're happy to get that, that's I don't want to say it's a blip, but it's an additional factor to just consider as we think about that portfolio. And it's one of the things that we think about as we consider underlying manager exposures. Our hedge fund portfolio, as you'll also for those investors in the diversified long-term growth strategy, we own our hedge fund portfolio as a reminder in lieu of additional if we didn't own hedge funds in the LTG model, we would own more fixed income. From that perspective, we're very happy with the way that the hedge fund portfolio is performing. This is what we anticipated we would get, which is basically flat to slightly down returns in a rising interest rate environment, which is what we've gotten. Also, fortunately we've benefited for some reasonable outperformance of the strategy itself. But as a tool for the overall portfolio, it's really hit expectations in terms of what we hoped it would do in a rising rate environment. And you can see that if you compare the year-to-date down 2.3% return versus the fixed income portfolio down, or the fixed income markets down 9.5 to 10%. So we're very happy with that exposure and that expectation. Our fixed income active results have been a bit behind benchmark year-to-date. We do have a bias to corporates and away from treasuries. And as investors, as you see in the equity markets where investors have tailed down their risk profiles, or they've tailed down their risk exposures, that's not dissimilar in the fixed income market. So we have seen spreads of corporate bonds and other non-treasury investments, excuse me, which we do own in this portfolio. We've seen those spreads widen out, and as a result, it's caused a little bit of underperformance. Fortunately, nothing terminal and nothing we're terribly concerned about. We still think our long-term positioning is the right place to be, and with the two active managers in the building block, but it has resulted in a bit of underperformance in the short term. You may recall we also, in addition to our fixed income portfolio, we have in our longer term funds held this position in sterling as a low duration component of our fixed income portfolio. So basically have had a dynamic view that rates would go up at some point, and that would have some impact. And so the sterling portfolio, owning the sterling portfolio, has added some value both April and year to date relative to owning more core fixed income. So we have been, in technical terms, we've been short duration on our fixed income allocation in the portfolio with sterling and a little bit of cash, and that has been additive in the short term as rates have continued to go up. If we saw some extension of this rate or if this bond recovery in the short term, we're less well positioned for that, and so we'd be hoping for some good active management premium. But our view is that rates, likely the trend is still higher, and so as a result, we continue to maintain this position. And sterling's continue to do a nice job overall. A little bit underperformance in April, but year to date outperforming. So what's that mean on the total portfolios? For April, all in all, pretty good execution. The income and growth, which is 40% stocks, 60% bonds, a hair ahead of our policy index for the month, but still down. Excuse me, active long-term growth, which is our long-term oriented portfolio that's all active public, about 40 basis points or 0.4% ahead for the target index. So really happy to see that. And similar diversified long-term growth, which is made up of the same building blocks, but with the inclusion of private equity as well as the hedge fund portfolio and global opportunities also outperforming for the month. So really pretty solid outperformance, and a little bit better by and large than our passive long-term growth, which is similarly allocated as the other two portfolios, but all passive. And so good premiums in the month. If we look for the full year-to-date period, a little bit tougher, as you might imagine, for the income and growth. 60% bonds. In most environments, we would expect that to hold up better, but clearly this has not been most environments. And that's probably expectationally one of the harder things that investors in general we're finding as we do client meetings are struggling with. But in an environment where the S&P is down, the S&P 500 is down 16 or 17% at the end of April, not bad in terms of holding up. The passive long-term growth down about 11.3, active long-term growth a little better than that at down 11, and the diversified long-term growth with the additional diversity of the private equity and those other asset classes have been able to hold up better in this environment, a smidge ahead of its benchmark, but only down 7.8. So that long-term strategic, by having those other asset classes in an environment where stock and bonds both, if you will, exited the building at the same time, has been able to add some value in that portfolio. So just from an outlook perspective, we do think there's a fair amount of uncertainty on the environment. So what are we doing to manage the current portfolio? Well, the first thing that we're not doing is we're not making any substantial changes to long-term strategy. We build these portfolios to live through multiple market environments, and we want to try and find that balance between generating the best long-term return that we can without taking a lot of excess risk. So at this point, we're not suggesting or making any recommendations to change our long-term strategies within any of the underlying portfolios. We want to stay diligent and disciplined as we think we've built pretty good models to live through this kind of volatility. We are looking for opportunities to actively rebalance and look at the portfolios often and look for, make sure that we're staying within regional tolerances of our long-term portfolio positions as well as our nearer-term dynamic positions. But we want to be actively rebalancing and make sure that we're maintaining our risk profile where we should be. And then we talk often with FFTC staff around short-term liquidity needs to make sure that we have cash available if we need it. In down markets environments that we see like this, oftentimes the cash flows from portfolios become more important, and so we want to make sure that we're well funded. We have good liquidity in the portfolios to be able to meet near-term needs, and then we also want to be prepared for any opportunities that might arise. It's been a long time since we've had serious dislocation in markets. I guess I say that with all deference to March of 2020. But that seemed like it lasted about 8 days, and then it was over. So it's been a long time since we have an extended distressed marketplace or dislocation, and so as a result, we just want to be aware and available to be able to adjust as necessary, whether that be through dynamic positioning or additions or subtractives of underlying strategies. So currently, dynamically, I've mentioned a little bit of this on the way in, but in our U.S. equity portfolio, we did recently reduce our small mid-cap risk. We took that back to target. So we had been overweight about 5% within the U.S. equity building block. We've pulled that back to target, and we had funded that by reducing our low volatility strategies. We did that as we came out of the 2020 sell-off, and we felt like economic environment was strong. There was an appetite for risk taking, so we had a dynamic position on where we had gone overweight small mid. As we think that environment has changed, we've just pulled our risk targets back to our long-term neutral positioning, and we did that over the last couple of weeks. So those are in place. We also are maintaining our modest overweight to emerging markets. We still think emerging markets are more attractively valued than developed markets. Emerging markets are ahead of developed markets in terms of the interest rate cycle. When inflation started to rear its head, it translated more quickly, if you will, or hit the ground more quickly in emerging markets than it did in developed markets. Emerging markets being much more experienced, for better or worse, with inflation, many of them acted pretty quickly to raise rates and try to get inflation knocked down. And so we could see a disaggregation of the rate cycle globally, where developed markets like the US or across Europe are still raising rates, where markets like China or other places are closer to cutting rates, given where they are in their inflation cycle. So we think those notions are relative positives for emerging markets. So we still have our marginal overweight to emerging markets. And then we're in our bond portfolio, as I mentioned, we're staying relative underweight duration, and we're modestly underweight in our bond portfolios. I continue to ponder that every day and consider allocations. We're partially underweight in bonds, excuse me, in our diversified long-term growth portfolio because we are modestly overweight our hedge fund allocation, and so we're okay with that. We think that's a good swap, but for now, that's our positioning, and those are things we continue to talk about internally in our investment committees and bounce those off of our deeper team. So I somehow went 20 minutes with that. Didn't go that long, so I will pause there, Greg, and see if we've gotten any questions, or if you have any questions we want to tackle along the way.
All right. Well, thank you much, Travis. And just a reminder, everyone, if you do have a question, we hope you do, put it in the chat window, and we will be tracking that. We do have a few. I'm going to combine two, I think, kind of related. Getting a question around, what do you think the likelihood of a recession might be this year, as well as are there any concerns about a stagflation type of environment?
I'm loath to put a number on the recession. I think it's possible, whether it's this year or next year. I think our house view is more likely for 2023. I think it will be interesting to see where second quarter GDP comes in, because first quarter GDP was negative, and the world is slowing. So there's a chance that we could see second quarter GDP negative and hit the technical definition of a recession before most people are thinking about it. I don't follow enough of those data points on a day-to-day basis to be able to say definitively, but that will be interesting to see, and what market responses will be to that. But we do, in general, we think the economy is slowing, and for good reason. The U.S. government is tailing back a tremendous amount of spending. There's a tremendous amount of stimulus that's not coming again. That can't be spent twice. So those are reasons why we might expect to see economic growth slow, in addition to inflation and the like, where it's just more expensive to do anything right now. So I won't put a number on it, but I do think that there's a chance that we could see a recession. And then the question is it a deep recession or a shallow one? I don't know that I could say definitively which way. Hopefully it's not a deep one. Hopefully the Fed can engineer a soft landing. That's really hard. They take a lot of heat, but that's probably one of the hardest jobs in the world to do. So I'd say slower growth. Stagflation. If we have slower growth and inflation remains high, I think that's the definition of it, right? So our expectations, though, for inflation is that we'll start to see it taper, the rates anyway, in part because we'll just have higher bases for the year-over-year comparisons. So, if you needed to raise a wage, if you needed to raise a wage, bring somebody up to a new base level, it's unlikely you're going to need to raise them the same percentage the next time you address wages. And so while we've likely seen a step function in overall costs, the rates we think will probably moderate as we move forward. So our current 3-year expectation for inflation is around 3.7. That might seem laughable to some when we just printed 2 8s back to back, but we do think that as the basis for each period resets over the next 12 months, we just think those rates are going to likely fall down. Still could feel stagflationary with slow growth and higher relative costs, especially if we continue to see high prices at the pump. I live in the Northwest. I have a diesel car. It's close to $6 a gallon for us to fill with diesel. I'm not sure what it's like in the Southeast, but I know in the Southwest, in places like California, it's well over $6 or $7 a gallon in some places. So that's going to feel stagflationary in any case.
Okay, thanks. Are there one or two factors you think are critical before this ends and we really start to see some market traction going forward and potentially get positive by the end of the year? Or do you think that's not very likely?
I'd probably, on the notion of getting positive by year end, I think that's not very likely. Pretty big hole to dig out of. So I can't do the math in my head, but if you're down 8, if you're down 11, what do you have to be up to, to get back to just positive? That's a lot. And all those factors I talked about, slowing growth, moderating, but still reasonably high inflation. The other notion I didn't talk about is that earnings in the U.S., profit margins in the U.S. are at cyclical highs. And so, if inflation is high, input costs are high, and economic growth is slowing, then one might presume that corporate earnings would start to move back towards trend, which means they would come down. That's not going to be good for stock prices, or wouldn't expect to be good for stock prices. So I think getting back to positive for the calendar year is probably a stretch. What could change that? Fed came out and stopped rising, just said they were taking a pause on raising rates. That could have that could trigger a buying trend. Certainly in bonds. Bonds have priced in a lot of bonds. Again, prior to the last couple of days, bonds have priced in, or last several days, I guess, bonds have priced in a full, 2.5+% overnight rate throughout the curve. And if all of a sudden it looked like we were not going to get to 2.5, then we could see bonds rally for sure. I suppose part of what would feed into the equity markets is how much equity market expectation is there priced in that could happen at this point. That would certainly influence the amount of recovery we get out of stocks, but I still find it unlikely. I hope I'm wrong, but I still find it unlikely that we could see equity markets move higher. I think the Fed is front and center right now. And, I suppose the other positive things you could see, I could be wrong on earnings, right? And wrong on profit trends or profit margins. And if those continue to trend higher, if we continue to see up, they expand, that would certainly be a positive. You remove the war premium from oil and wheat and similar commodities that's coming out of the Russia-Ukraine conflict, that could cause a rally. Again, I just don't know that there's enough rally left in it to get back to positive, but those would be things that certainly would push asset prices in the right direction.
Right. Well, thank you. We do not have any more questions. Again, thank you, Travis and Tim, for taking some time today. And thank you to the participants. We hope you found this helpful. We'll continue to evaluate whether we have another interim special webinar. But thank you again for being here today. And again, we will post this to our website, fftc.org, as soon as possible. And certainly hope the rest of your week goes well. Thanks, everyone.
Thanks all.
Take care.